Good morning, ladies and gentlemen. Well, by my calculations, the risk dial is very neutral around zero. And so is the market. The market just can't make up its mind whether we are in risk on or risk off, or whether all assets are still tied together. And I think the answer is that they are still tied together. I will now examine the reasons why, but I think for this conundrum to resolve itself, we need to have clear, consistent data about the economy, and we're just not getting it. We're getting one strong number, although lagging, and then we're getting another weak number or very weak number looking forward. It's very maddening, but it should resolve pretty damn soon. I want to start the bond review by having a look at the yield curve. Current 1 month ago basically, and 3 months ago. As you can see, the 3 months ago is by far the highest. Twos are still relatively tied together. We're trading up and down 20-25 basis points. But the biggest move in the curve has been from the threes out to the fives, out to the tens. So what is the market saying? That basically that over the last month, very little has changed in terms of information. We've gone up and down, up and down. But over the last 3 months, it's basically saying that the market believes that the economy is on the cusp of weakening, and therefore that rates sometimes in 1 to 2 years' time will be a lot lower than we were discounting that they would be 3 months ago. You can see this move in the fives, that basically we're trading 426 and now we're trading 377. So let's call it 50 basis points. So we've reduced the fives by 50 basis points, and we've reduced the 30s by a little bit less. The 30s will now move the least. It's going to be the belly that moves the most, and eventually the twos that move the most, with the yield curve going flat to positive again at some stage. So that is the overall picture, and it's important to keep that in the back of your mind. What are the individual tenures doing? Well, the short end is still heading higher. As you can see, this is the 3-month bill. On a daily chart, we are still going up and up and up. The 1 year is absolutely steady. We still have not broken out from the 480 area. But as soon as we start getting into the twos, they're beginning, the picture is beginning to change. I would be very surprised if next week we break below 415, but that will be a signal to me that we are actually heading down towards 368. And that can only happen on a weak CPI. Next week, what do we have? We have 3s, 10s, and 30s, and we have the CPI, which will basically decide. But until we start breaking below these lowest levels that we've had for the best part of 3 months, right? And that is around the 413, 415 area. We are still in a range. We're still in a 20, 30 basis point range in the twos. The twos will be, to me, very, very important. The threes, we can get down here or probably on Monday just through sheer momentum, but it's not going anywhere until it breaks those levels. Fives, much the same. I would be very surprised to see before CPI a closing break below 362. And the tens and 30s, I feel, are going to be the most stable. because either the yield curve now starts flipping one way or it starts flipping the other again, meaning that the 10s and 30s are the ones that are going to move in yield the least relative to the others. So much the same sort of thing. I can see that the 3s getting down to this level, but this is an incredibly important level, and let's have a look why. Here we are. We basically spent the best part of a decade trading with that as the top. So it's going to take quite a bit to force us back down below 324. To me, 324 is going to be absolutely pivotal and a great risk reward, short in terms of futures, long in terms of yield. That is the level. And here we have the 30s, which again I now think are going to be the stablest. If we take it back down to the one day, I really would not see the 30s below these levels around 360 to 345. I think there you are getting paid a very good risk reward price to see it back up, because the yield curve has to move before these prices actually can readjust down. So if we have a look at, for example, the 2s, 10s, I would have thought that 2s, 10s at some stage have to come back down and test this 50 level again, 47 level, and 5s, 30s even more importantly. If we can find that, they keep on failing at this 11 level, which to me is very, very pivotal. Unfortunately, I think that we're going to see a lot of this on this side, and it's going to take a long time for the yield curve to then start breaking down and signaling the end of the inversion. The end of the inversion can only mean that we're getting clean data that the economy is weakening, and that the Fed's terminal rate, whatever that might be in the end, has been achieved, and that the market thinks that the next move by the Fed is going to be cuts, and not little cuts, but substantial cuts, because to get the yield curve back to flat to positive, i.e. its normal state, you have to have funds down towards the 3% area. So that is, that is going to take a long time, and it's not going to have to be one set of data like we got the PMIs on Friday. PMIs are, I think they're very important because they're forward-looking. But it has to be a consistent set of forward-looking and current data, I would suggest. So you have to have weak current durable goods. You have to have weak current retail sales. You have to have some hint of the labor market coming back from this incredible tightness it's had. And you have to have, most importantly of all, CPI actually coming down, and in the core as well, and in the services sector as well as goods. I also wanted to show you the charts of SHI, IEF and TLT for those that are trading the bonds via those ETFs. These are the really, really important levels. And to me, SHI is going to trade between 80 and 82.8 for a long time. And I'm talking months. IEF, again on a monthly chart, this level, which matches with the one in the 10s, This 99.35 on a closing basis, I think, is going to be very, very important. And it's tough to see it closing a month above it. I think this is the stability period and the whipping up and down that is going to completely stop people out both ways. Unfortunately, I think it's going to take a considerable amount of time before we get another trend in bonds. TLT, I think, is going to be very significant to get a break above 108.75, and that is, and closing above 108.75. I think that's terribly unlikely for the time being. So all these charts tell me that we are going to go sideways for a long time, with the yield curve steepening and flattening according to the latest bit of data, i.e. very little trend. And if you go back to the 530s yield curve that I showed you, that implies a long period like here of going sideways between some 40 level down towards some minus 17, 18 level. You're talking about 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 months of sideways before you get ready to break down. And that is what is so maddening, that you're going to have a long period of going sideways while the economy first gives you a signal that it's really weakening, then it gives you a counter signal that, well, maybe not yet, and then it gives you another one and another. Basically it's ping pong back and forth until it finally does weaken. But all these charts tell me that the levels are going to be incredibly hard to break, and that it's going to take a long time for that to happen. And unfortunately, I think the same applies here for Germany. This is a chart of Schatz 1 month. Look at this period here. Is it possible that we get something similar? Very possible. If we change that to a daily, I said last week that I think that we will trade 268 for a long time, up and down, and I think that that is what's happening. This candle here is the ECB candle. Is it possible that we come and retest this kind of level? Absolutely, but I don't think that we go through it, and that's going to be that 106, maybe 106 and small change level in Schatz, where I think the risk reward is again for a test of 268 again. So you're talking about a range in Schatz of 106, 10, 15, all the way down back to that 105, 40 level. And I think that that is the range to play. If we look at the fives, those haven't broken the ECB candle and the level. I think, they come and retest this level and then they bounce back up. And the tens, I think this is the ECB candle right here. It's quite possible that we come down towards this 208, possibly around 199, just to stop people out, and then go back up towards 240. That is the kind of trading range that you're going to be for quite some time. The French market, which is the one that technically trades the cleanest, this is the ECB candle, and then we just continued. Now we probably come back, test this ECB level towards the 258, and then go back up towards 3. Again, everything that I'm looking at is showing you the indecision that the market is experiencing at the moment, and that is because of the noisiness of the data. Whatever you get is reversed. So basically what I'm telling you is, don't get married to any one position. just basically trade it from level to level, which is what I prefer to do in any case. So this is going to be a trading market with basically you do call spreads or put spreads at levels, and I think that you're going to be rewarded for everything that you do at levels. If we look at the differentials between the US and Germany, I think we're getting the same story. We are now in a range. This is the twos between 150 and 193. I think that is quite clear. And we're going to stay in this kind of range for quite some time. If we look at the tens, much the same picture. I think any retest of this 152 area is going to get sold. But I just can't see it coming through this 125 area, which, you know, matched very, very well with the low in the Schatz. So to me, we're going to stay in this area for quite some time, and really the breakdown is going to be very significant now, because that means that it's unlikely that the bunds move more than the tens. So that will match with the tens going down. And as I told you, if the whole yield curve shifts down, that can only be because the twos and the threes are shifting down more. Because the Fed is, or the market perceives that the Fed is no longer going to be tightening, but it's going to be easing. And that, I think, is still a very long way away, you know, many months away. And therefore, I think that this is going to remain trading in this range. And when it starts breaking down, that to me will be a signal that the whole of the US yield curve is shifting down, and that can only be because the Fed is beginning to ease, or the market is anticipating Fed easing, as opposed to now that all we're doing is we are anticipating where the terminal rate is going to be. Is the last tightening done? Is there one more? Are there two more? We're trying to feel out where the terminal rate is. We're still far away from deciding that we're going to get cuts as opposed to an end to hikes. The dollar is beginning to be interesting. I think 102.82 and a weekly close below is going to be very significant, and you're likely to get a move in that case of at least 2 or 3%. And I would have thought at least to this area here between 99.83 and 98.81. You can see that it's basically always done it. And I would anticipate much the same sort of thing. And then it catches basically the 200-week moving average, you know, somewhere around this 98 area, 99, whatever it happens to be. But I think a weekly close below 102.82 gives you a trigger down towards the 98 something area. So, you know, what would that mean? That would mean surely a weak CPI. And I really can't see how, if I'm not looking for the differentials between the in the yield curve that I just showed you between the US and Germany to move very far apart now, that can only mean that the US economy per se is weaker than expected. Could it be that the ECB gets more hawkish? You know, it's unlikely, because it's already sort of at maximum hawk, as it were. So it's unlikely that the move comes from the European side. It's much more likely that it comes from some sort of a weakness in the US side. That would match up with the lower levels that I gave you in the in the bonds, in the US notes and bonds. And that's why it would stop around this 100 to 99, whatever that happens to be, to 99 area in these three, just like it did here. Or I mean, these are weekly charts, so you can see that it kept on trading here, you know, on these levels, and that would basically tell me that we've reached as far as down as we're going to go in yield in the US, and then we get the bounces back up towards this 104, 105. But certainly this area here is going to be quite quick, between 102.82 down to at least 100.39. How would that match up with Euro USD? Well, I think the level becomes just under 110. 109.92, and that, funnily enough, is the maximum likely retracement, the 0.78, whatever it is, of this move. So it matches up quite well, and it also catches the more or less the 200 period moving average. So I would have thought that the move is likely to peter out around this very pivotal 109.92. You can see how many times we tried it, and every week then we traded, and it was either support or resistance. So I would have thought that that is the level that matches with the DXY around just below par that I showed you. Gold has had a couple of good weeks, and really that's been the combination of the bonds and the US dollar. If I think there's going to be a very rapid move in that US dollar, and let's say it does go up to that 109.90 area in Euro USD, what is likely to happen? Well, we are overbought on the weeklies, but we are still in an uptrend. I would have thought that the likeliest thing, and let's go to a daily, and you can see what happened, is we're very close to a test of 1881, but every time it tries to break 1881, it goes to at least this area here, which is 1921, and then I would have thought it's because of the severity of the move in the US dollar, if not so much in the bonds, it's likely to trade 1958. But I would have thought that there you really don't want to know too much about gold, because if the CPI is now weak and they start looking for cuts, I don't know whether gold is going to start performing worse than bonds. And therefore, at this round 1958 area, I think I will be on an asset allocation basis. You probably want to start getting rid of gold in favor of something which has yield. As you can see here, this is the lowest weekly close we've had in DBC for an awful long time. I can enlarge this for you. And, this was the previous lowest close, so we are through it. I would have thought that this has to be some kind of an ABC, giving us, levels at least down to here, and that is actually reflected in this chart that I like very much between gold and DBC. This is where I started switching my DBC into gold a long time ago now, right? And it's beginning to finally pay off. I would have thought we trade this 1776 area no problem, and we might even trade this kind of area, which I will put in around 8 something. But I would have thought that in this kind of area, 819, in this kind of area, you want to basically be neutral between DBC and gold again. It's quite easily that it can have a 5-6% move back down towards the moving averages before it goes again. What does that tell me? That tells me that DBC remains weak for a bit. That can only mean that energy remains weak. That can only be a stabilizer for bonds at the very worst, right? A stabilizer, i.e. there is no more pressure on the inflation front. And if that continues to happen, then we are at best in a range or at worst in a range in bonds. And while we test some kind of a downward target in the bonds, for example, that 324 crucial level in the 10s, and then we come back. So it's all beginning to basically mesh together in terms of a view that bonds are going to not do worse, but they are going to trade to levels and then from levels, while overall being in a stable range. That's what I would say. And probably CPI, probably inflation keeps on moderating, giving the market a whole load of false starts and impetus for whole starts. Well, people get very bullish at ridiculous levels and then have to get stopped out, and then they go again. So I fear it's going to be a range-bound market, which is a trading market, which is really not bad for us. I also wanted to show you this weekly chart of TLT gold. I know it's distorted because TLT has dividends or coupons or whatever you like to call it, and gold doesn't. But if you prefer gold down here to TLT, what you are saying is that basically these are the worst levels since 20 years. Is that really realistic? Are we in a very bad inflationary phase that the Fed can't control? I don't think so. I don't think that we are in the same phase of the 70s or early 80s at all. I think the mechanisms for reducing inflation and the type of inflation that we're having is not the same type as the 70s and 80s. It's not labor militancy, it's not trade unionism, it's not a wage price spiral. It's very unlikely that you are going to make a lot of money by holding more gold than TLT. Looking at this chart, I think it's far more likely to come back, and that to me implies a reduction in gold holdings when you get to that 1958 area. I want to start equities by looking at European equities, and you tell me this is a bearish chart. Okay, this is the daily on this side and that's the weekly on that. Is this a bearish chart? Is this a chart that tells you that equities are about to swoon? I mean, I don't see it. I think it's far more likely that it comes and tests this 41.38 area or 41.27 on the weeklies. It just does not look bearish in any way, shape or form. Look at this weekly candle. Look at the fact that we've been going up all week. If Europe is not bearish, and we can agree that this is not a bearish chart, right? Then why should the US be be, why should we be looking for US to go down? I just can't see it. At worst, we go, up 1%, down 1%, up 2%, down 3%, and then just crab around. So if Europe is not bearish, and there are no reasons to sell Europe, and Europe has a more or equally as hawkish a central bank at the moment, and their yields are at best going to be stable compared to the differential to the US, why should we be expecting SPX to crap out? I just don't see it. I think it's much more likely that those relationships hold stable for quite some time. And don't forget that basically now we are at the highest levels that we have been since this bar here, which was, let's see, what is that? That's late February of last year. Okay, so, I just don't see the argument that we are going to have a very bad situation in SPX. I just cannot see why. And if we have a look at the VIX, where is a complete dismantling, I don't know what to call it, of SPX going to happen with VIX at 20? It's just not going to happen. I just don't see what people are smoking. We still have this gap down towards 19, and I bet you that at some stage this gap gets filled. So to me, SPX is just not a sell. Do I think it's a massive buy? No, I don't, and I'll show you why. But it's not a sell. I mean, where's your risk reward? I think you are selling it for 20, 30, 40 ticks, and you might see it 200 in your face. Another chart that I want to show you is EEM. It's broken through on a closing basis through 39.93, and if you have a look closely at this chart, every time it's done that, it's basically traded this 40 to 41 area fairly quickly in the next week or so. That is, funnily enough, where the weekly Bollinger Bands come in, and that to me suggests, from 40 to 41, that's another 2%. It's not a big move, but it's certainly, if EEM is going up 2%, if Europe is going up a couple of percent and coming back or whatever, that is unlikely to mean that you get a 2-3% down in US equities, isn't it? I mean, I'm just trying to put all the pieces of the puzzle together, and I'm seeing EM being strong and with impulsion higher. I'm seeing EU being strong with impulsion higher. I really can't be looking down for S&Ps. So this is now S&Ps against FEZ, which is the, let's call it stocks, all in dollar terms. You can see how much it's come off. I mean, we've come off from 12 to 9.5. That is a humongous move. And I'm very, very annoyed with myself that I didn't catch it. To me, this level now becomes absolutely pivotal. 920, let's call it. And we're 944, so we're a couple of percent away from it. I think it's very unlikely, and risk reward says that it bounces from this level. At this level, I really want to do some plays, some option plays, because I really cannot see that this is going to break somewhere that it hasn't basically been below since the mid of 21. The situation is not such. I mean, okay, so Europe is not falling apart, but that does not mean it's going to start performing better than the US. I know what the usual arguments are, about defensives and no tech and stuff like that. But unless I'm looking for US yields to start outperforming European yields on the upside, I don't think tech is going to be a huge problem for the US right now. So I just can't see that we are going to bust through this level. And if all we're going to get is this kind of level and then some kind of a bounce, which I think at some stage we get a bounce at least to 922, that to me again indicates at least stability in the relationship between the US and the European equities, which at the end of the day can only mean that we're going to see at some stage higher levels in the S&Ps. Would slightly higher levels in the S&Ps be against the fundamentals? I don't see it. If bonds do another 20 basis points better or something like that, that pumps the P. The E is not really falling apart. Earnings season is backward looking, right? So the earnings themselves should not be too bad, because we know that the economy performed relatively well in Q4. The only thing that you could be afraid of is forward guidance. But we're not going to get that for a while. So would 4,000 be against the fundamentals? No. I'm not looking for anything above 4,100 or anything like that. I don't think that we break the times 18 Blue Angel anytime soon. I think we're still in a downtrend and still likely to find that anywhere near there a reasonable top. But we're just not in an impulsive move down at the moment. And why should we be? If bonds are not doing too much worse, and we still don't have confirming data, as I said earlier, we need current and forward-looking data to finally start showing some synchronicity, rather than one being weak and the other one being strong. While that is happening, sideways to up with the bonds seems to be the most logical move for S&Ps at the moment. So what kind of levels is my clean chart suggesting? Well, it's suggesting 39.83, 39.84. And that is nice because it just fills this gap here, this tiny gap. So anything around the 4,000, what I'm thinking is that no way do we go through 41.26. I think that is a bridge too far, but we could get spikes above 39.83, get the futures, the ES futures above 4,000, get some people bullsed up, and then we come back into a range. But I really don't see why, when we have failed so many times around this 38.26 to 3,800 area, and when the support has held so well, why would we be looking for a breakdown at the moment? We would need some incredibly bad data for that to happen and to stick, more importantly, because 37.22 is also fantastic support. That's why I think it's more likely that we trade 4,000 next week rather than not. Whatever you might think about the ultimate path of the economy and what the Fed will do to interest rates and therefore what equity valuations will be, you have to recognize that the timing comes from the technicals and i.e. the price. This is SPY over SHY. I don't think we can say that we're in risk off and continue to be in risk off, which means buy bonds, sell equities, until we start breaking this level, 441. The levels in all these relationship between SPY over SHY or SPY over IEF, or whether it's SPY over TLT, are pretty damn clear to me. And in none of these charts do I see a current bearishness that would indicate that we are going to go into risk off. Risk off meaning risk off, as I said, buy bonds, sell equities. If that is not the case, you have to say that within a couple of percent, bonds and equities are still tied together. If that is the case, trade it. If we were in an immediate risk of risk off, would SPY over XLY have come down on Friday? I don't think so. If we were in an immediate risk of risk off, would XLP over XLY have come down on Friday? Or at least closed at the same levels as the day before? I don't think so. Could we, is the market defensive? Yes. Is the Dow or the Dow stocks performing better than aggressive growth stocks? Yes. But that does not mean that the whole of the indices are about to fall apart. I thought iGov, I keep on looking at this chart, and can it get bearish in a hurry? Yes. But is it showing any sign at the moment of being anything but in a range? No. And I think it's going to take a long time for it to become true risk off. And it has to be when we start breaking these levels, just like the levels that I showed you in SPY over SHY, SPY over IEF, SPY over TLT. I'm boring, but I'm boring for a reason. I want to stop you making, sort of bearish mistakes and getting squeezed out and then getting out at levels that you should be getting in SPY, because I think that 4,000 to 4,100 area is going to be a wonderful area to get short. And with that, I've updated all the levels. I think next week we look at the Schatz again and hope that it gets to around that 00 to 10 area, where we definitely do some put spreads, calendar put spreads, and I'll tweet it to you. I think the bonds are in a range. We shall try and, if the first move into the auctions is a bullish price move, I'm quite happy to have some put spreads from those higher levels that are from those lower yield levels that I've shown you, and I'll mark down here. I think that whatever the CPI is, it comes back at some stage from those. So I'm quite happy to have put spreads on at the lower yield levels. Still think it's all tied together, still think that XPX stops everyone out at around that level, and then we see. I think it's much more likely that we are in a range overall, and the one thing that I think is prudent and opportune is to lighten up on gold allocations at 1958, and I'll tweet all that to you next week. Thank you very much indeed, and have a wonderful weekend.